Well, good afternoon, ladies and gentlemen, and welcome to today's presentation, the Power Options in General, Radioactive Trading Open Forum Q&A session for this afternoon, Friday, January 30th, January 30th, 2015. Well, it's great to see you all here. I hope you all had a good trading week, although we've seen a lot of hiccups in the past few days and a lot of switches in the market and a lot of ups and downs with the various earnings reports that have been coming out over the past few days. So, of course, we want to get started, we want to see what your questions are and see how we can help you with the various questions that you have. Now, first we always want to begin with what exactly is Power Options. Well, here at Power Options, we are a patented suite of search and analysis tools designed for self-directed options investors. Our tools allow you to search across the universe of options and over 23 of the most commonly used option strategies to find only those positions that match your personal risk-reward tolerance. You also have tools where you can screen one stock at a time in a given strategy or across various strategies as well. Once you've identified those positions, you can quickly do further research and analysis on the stocks and on the options. And we do offer a powerful set of portfolio tools to help you paper trade, track, manage, and evaluate rollout opportunities on your options positions. We, of course, also offer countless educational articles, archived webinars, and help videos to help you get more familiar with the tools on the site and, more importantly, the various option strategies that are available. Now, we have been in business for over 17 years, but everyone here on staff at Power Options uses these tools to trade their personal accounts, myself included, so we have many more years of combined trading experience. For those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Ernie Zerrenner and the Power Options staff for the past 12 years. I handle a lot of coaching sessions, education, and the webinars and help videos for Power Options and Radioactive Trading. I have co-authored 2 books on investing, and I am versed in all of the strategies that we support on the site. However, I always want to be upfront. There are certain strategies I've never traded in my personal account. Things such as short straddles, short strangles, iron butterflies, or naked call positions. And those strategies just don't match my risk-reward tolerance. However, if you do have questions about those, we'll be more than happy to handle those for you. Now, our process and procedures for this afternoon's presentation, when you logged on to the webinar, the GoToWebinar platform should have appeared on your screen. Inside that platform, of course, is a question pod, so just open up the question pod, type in your options-related question, and send it to us. Please feel free to ask any questions that you want, and as many questions as you want. We're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time, but if we have a high volume of questions, we'll be sure to stay online for a little bit longer to make sure all questions get handled. Questions can really be about anything. If you have general questions about the tools and Power Options, most of you probably have questions relating to general options knowledge, options comparison of the various strategies, rollout opportunities, deciding when to roll or adjust a position as well. If you have questions about the concepts of radioactive trading as well, that's all fair game. Anything related to options trading, options investing, strategy comparison, evaluating parity trades or synthetics, that's all free game. So feel free to ask any questions that you want related to the option strategies. Our basic ground rules, of course, don't be shy. Ask any question that you want. This presentation is designed for you to have an open and free forum to have your questions answered. We do ask that you be patient. There might be 1 or 2 questions ahead of yours, but as I mentioned, we will stay online if we need to get through all of the different questions that come in if there's a high volume of questions. Lastly, I also encourage you to feel free to help us help others. So if a question comes in from one of our attendees, and I give a response based on my market experience and education, well, if you have a different insight, you've used a different management technique or adjustment, or there's something that you look for that you feel is important and very useful when researching options trades and options strategies, use the question pod to send that to me, and we'll share that with the rest of the audience and inform them of your techniques in addition to that. So we encourage you to help us help others as well. All right, well, that being said, let's navigate over to the Power Options suite of tools. I did have a question that came in via email prior to the presentation starting. And, of course, the question was related to sort of when I'm in a covered call position or an option strategy position, how do I know when to adjust the position? How do I know when to roll or make an adjustment on the position? Well, that really comes down to your, I'm sorry, folks, let me make sure that the view is shown up here. Yeah, there we go, okay. I'm sorry, that really comes down to your view of the stock, the current situation, of course, and what you're looking to accomplish. For example, let's see, I've got a stock here that I'm trading in my personal account it's Boise Cascade. So let me go ahead and look up that position. I'll type in BCC and let me go to the option chain here. And I'm going to go back in time. I'm going to look about a day's past. Stock hasn't been moving that much. It's currently at 40.55. Let's go back about 10 days or so. So let's go back to about, let's go back to the 13th or 14th. No, let's go back to the 20th. Okay, let me go ahead and get the chain for there. And at the same time, BCC, Boise Cascade, was at 40.09. And the stock was trading again at 40.09. And the February 40 strike call had a bid of 140 and an ask of 185. So let's call that a bid of 160, or a premium of $1.60. Now what I'm going to do is I'm going to go to my portfolio, and I'm going to go ahead and add a new position here. So in the Portfolios tab where I track my open positions, we're going to go ahead and enter this covered call, and we'll use it to compare our other two covered call positions as well. So let me type in BCC, and we were going to do, let's say, a simple trade of 100 shares, and this was back on January 20th, and the stock was trading at about $40.10. At the time, we could have sold the February strike. All right, so I'm going to go ahead and select my option, set the 40 call here. At the time, again, on 120, based on that historical chain that we saw a premium of about 160. We're going to use sort of a midpoint pricing there as well. All right, so here's our covered call on Boise Cascade. Entered the stock at 40.10. It's currently trading at 40.54, so it's moved up in price. We sold the call for 160, and the current ask price is $1.95, so it's moved up about 30 cents or so. It's a gain of actually 22%, or in our case, it's a loss because we sold the call initially. Okay. All right, and so what we're looking at here is that we see that our original expected gain was 3.9%. Of course, we've only been in the position for 10 days. The stock hasn't moved that much. So if we sold to close the stock now and bought to close the call, we'd only make 0.2%. And if the stock continues to move up in price, or it stays above 40 for the next 23 to 30 days, we'll make the maximum profit that we expected of 3.9%. Now, the most important thing to me is that any time you're opening a new trade, okay, whether it's a covered call, a long put, a married put, collar spread, whatever the position is, you always want to have your trading plan set before you enter a position. So here I am. We've gone through the process. We skipped over it, but let's say we went through the process of research and analysis. We selected a stock that we felt offered a good covered call return that matched our goals. Beforehand, I would have already written out my trading plan and decided that what I'm looking for a 30 to 40-day trade is a return of at least maybe 2.5%, 2.8% or greater for a return if assigned, along with maybe a 3% downside protection. So BCC would have been one of those covered call opportunities. If I ran the search on the 20th, it would have matched that criteria. Did my research and analysis, looked at the stock chart, the company information, made sure it was a position that I wanted to enter, and so we've entered into this covered call right now. But I was going to have specific goals in mind and specific plans in mind before I entered this trade. Well, my plans are, of course, to make the higher profit. Let's go to the profit and loss chart here to get a good view of BCC. All right, so this covered call opportunity, generating the max profit potential of $150. We gave up about 10 cents to the intrinsic value when we entered the trade. We were hoping to get assigned to make the 3.9% return. As with any covered call or naked put position, we do have a large risk to the downside if the stop gap's down suddenly against us. We'll take a look at one of those examples in just a few moments. But we're hoping to be at least above the break-even of 38.50. Now the break-even that's shown here at 38.50, that's the break-even at expiration, not at any day between now and when we open the trade. The first day I opened the trade, the break-even was probably only $40.05, would have been the listed break-even. But in this case, the break-even at expiration on February 20th is 38.50. So I may use that as part of my requirements. In other words, I may look to adjust this call or roll this call down if the stock drops below my $40 strike price, but if it drops below my break even before expiration, that might be a target point for me to manage the position. As we get closer to expiration, the one thing we know as options investors is that, well, the guaranteed rule is that the time value of every option will go to zero as we get close to expiration. Well, if the stock stays around the same price, and as we get to expiration, this option keeps decaying and decaying, in 4 or 5 days to expiration, this option is only worth 20 or 30 cents, and we've made more than 80% of what we expected to make on the position, I may look to buy back the call at that time as well, because I've come close to maximizing the profit I expected, or I may look to roll it out to March or the next available expiration, depending on how I'm trading in order to do that. So those are just some of the target ideas that we might use for an upper range and a lower range. And if I was expecting to make more on the position and the stock started to move up consistently, well, I may also use the stock price of, let's say, $42 or $43 as a timing of when I might look to buy to close my 40 call, maybe try to roll to the 45 if I can get a higher profit by doing that. Sometimes you might not be able to by rolling up, depending on the premiums that are available and what you originally collected on the option. Okay, so all that being said, now that we have some of our views here, let's go back to the profit and loss portfolio. And what I'll do now is I'm tracking the positions in the profit and loss portfolio, is I'll click on the alerts column and I'll click on view, and this will allow me to enter various alerts. So I can set alerts for the stock, price limit, or an increase or decrease. We can set limits on the option price, reminders about the days to expiration, but probably more importantly are things such as the days remaining towards earnings and the days until ex-dividend if you happen to be selling a covered call against a dividend-paying stock. All right, so for my stock price limit, we already discussed this. I'm going to use that lower limit that I evaluated on the profit and loss chart of $38.50. I'm just going to mark this as a red warning because that would signify that the stock is dropping against me and that I'm losing value on the position. And at the same time, my upper stop limit, again, I might put up at, let's say, $42.50, halfway between the 40 strike that I sold and the next available strike. We'll mark that as a profit, where I may consider to roll it or just be thankful that I'm looking to get assigned and earn more return. We talked about the option price change, so I may want to set an alert that if the option decreases by 80% of its value in my favor, then I may look to buy it back. We could also put in an increase as well. Might not do that in the case of a short call or a short put, depending on what your outlook is for the position. This is something you might use for a long call strategy, for example. If you're in a spread, you could set the position change, increase or decrease, to be notified if you're losing 50% on the spread, or probably 30% would be a better one to use, or if you've already gained perhaps 60 to 70% in your favor as well. Now, if in my search criteria I'd found this covered call by putting in one of the fundamental filters on the PowerOptions search tool to look for stocks that were trading above their 20 or 50-day moving average, I'm probably going to be notified if the stock's trading below the SMA 50, and that would be a warning. And again, of course, the days until days until earnings, if I want to be notified if I'm within 4 or 5 days to earnings, and ex-dividend date as well. All right, now that I've set those alerts, let me go ahead and save those. I think the 50-day moving average might be triggered. Oh, no, I was wrong. Okay, so right now we see that view. Now, right now nothing's been triggered on BCC. Remember, we got into the position at 40.10 10 days ago. We sold the February 40 call, which had about 30 days to expiration, for $1.60. The stock's moved up about 40 cents. The call has moved up a little bit as well. But in this case, it's only been a short time frame. I'm in no risk now of the position. I'm in the profitable zone where I want to be. So right now, there probably isn't any time to do an adjustment. But what about other positions that can go for you or can go against you? And I took a cherry pick, to be honest with you, a couple of examples here from recent earnings from the other night that were disastrous and successful. Part of the problem with the covered call trade with going into earnings is that you leave yourself massively open to the downside, of course, same with a naked put position, if the earnings does not go the way that you want. In fact, we would advise not opening a new covered call or naked put position, probably even a bull put credit spread we wouldn't recommend doing if you have earnings coming up on the stock between now and the expiration date. Here's an example of Decker's, D-E-C-K. Some of you might have seen this today. But on January 20th, again 10 days ago, the stock was trading right about $80 per share. We could have bought stock at $79.50, sold the January 80 call, the weekly call that expired today, for $3.70. Of course, it was highly inflated due to the fact that the earnings was coming out yesterday prior to today's expiration. And what I probably would have done if the stock would have dropped or was still trading around this range, I probably would have bought to close that call or tried to add a cheap put for protection. Now, of course, we see today the stock's down to 66.05, dropped 16 points, about 18% at one point today because of poor earnings at the close of last night. It opened down at about $68 per share. Why is that important? Well, it's important because if I had entered this position by buying the stock at $79.50 and selling a $3.70 call, and let's say I put in a 10% stop order, so I wanted to be stopped out of the position if the stock dropped down to $72 or maybe something even closer, maybe $74, sort of an 8% decrease. Well, with this gap in the position, if I had that stop order in place in this covered call, the market opened today at 68, well, we would have kept the $3 for the call. We would have been able to buy this back cheaply on the contingent order from my broker, but he's not going to be able to get that $74, $73, or $72 at market price. He's only going to be able to get the $67, $66 per share that the market's offering. So we're not going to stop ourselves out at that 5% loss. We're going to take more of this 18% loss that we suffered on the downcrease of the stock. We hedge that with this high rich premium, but we're still looking at a $13 loss on a stock. And now that the event's over and the volatility has collapsed on the option positions, with roughly a 14 or 15% decline on the position, if we're generating 2 to 2.5% per month, well, we're talking about 7 months or so to get back to break even and hoping that the stock doesn't gap up above the lower strike prices we have to sell now. So is this a position that you'd look to roll? Well, it already went against you. So now with this kind of decline, we have a few choices, but the two main choices are, number one, leave the position open, let it expire, and then next week maybe look to roll to another call position. We could let the call expire, and then we could look to close the position on Monday, sell to close the stock, take the loss, accept the loss, and move on to the next position. No one really wants to do that. We just mentioned that as an option because sometimes if you don't have any further upside on this position, simply rolling down the call, if the stock continues to fall down to $64, down to $60, down to $58 in the next couple of months, you're always going to lose more on the underlying stock than you're going to be able to gain rolling down with the call option. And it's the same way on the other side that we'll look at later. As the stock moves up in price, you're always giving up more on the stock gain than you can possibly receive back by trying to roll that call up in price as well. All right, so as I'm tracking the position, we'll go to position actions and position analysis. Again, as before with Deckers, I would have already had a trading plan in place when I entered this position. And if I decided to stay in this covered call through earnings, right before the earnings event, would have looked to have tried to find an out-of-the-money put that was rather inexpensive, maybe at the 70 strike or something along those lines. So if this did happen, although I had to pay money for the put, at least it guarantees me some money back where the stop loss is just assumed insurance and it wouldn't have helped me in this situation at all. All right, so the stock has dropped. We see that we have an unrealized 12.9% loss on the position. So that's total. That includes the premium we received plus the loss in the stock, sort of 13% loss. Now, if we roll out with the stock at 66, if we roll out further in time, or we roll out the position, we can go to the 6th of February, 1 week out in time, the 13th of February, the 65 call, which is about at $2, but this is not getting us to a profitable zone, is it? And remember what I said. When we looked at this position 10 days ago, the stock was at 79, and we sold the slightly out of the money 80 call for 370. We were able to get that premium because of the earnings event that was upcoming today. There was a lot of volatility in the stock, the fear, the risk in the market. Notice now that the out-of-the-money positions for the 10 or 14-day trade, the 65 is slightly in the money, the 66 is just right at that price, a little bit out of the money. But notice how the premiums are half that, 190, a little bit more than half, but 240, and that's because of the volatility crush. I'm not going to be able to get the same 370 premium by selling out of the money call month by month by month now that the event has happened. The volatility has collapsed. There's no more, there's still risk in the position. There's still fear because of this decline in the poor earnings. However, I'm not going to be able to generate 370 to make back quicker that 12% loss. We're only going to be taking in about 1%, 1.5%, So we're taking our risk from 12.9 down to 11.5%, down to about 10.8% with these potential premiums for the shorter term. Now, many of you will say, well, why don't you just roll farther out in time and try to roll for a credit, meaning, or roll for a profit? Okay, well, let's scroll down. Let's keep going. We can go all the way out to April, which is 77 days out in time, and we're still looking at a max return at the 70 call, slightly out of the money because we don't have the single strikes. Those single strike differences are only available in the weeklies at this time. Everything else out to March and April is the 5-point strike difference in normal expiration chain. But this maximized at the April call, which does yield 265, is out of the money, puts us at a 4.4% loss if assigned. Okay, well, the 65 call, which generates 480 for April, 77 days out, only hedges us, makes back about 4%. That's good, but that's for an additional 77 days. So it's really like only earning 2% per month. So we have the loss of 12.9% now. We could lower that down to 8.5%, which is 4.4. So we're looking at a 2.2% yield per about 30-day period. Actually, it's about, if you divide that by 2, of course, we're looking at about 38 to 39 days out with a 2.2% yield per day, per 38 days, excuse me. So what do we do with this position? Well, there is a third option, of course. It's not something that we truly advocate doing. But the third option, of course, would be to, now that the stock has dropped, you may just let the call expire today, or you may have bought it back for 2 or 3 cents, 5 cents, whatever the buyback cost was, and then you may have looked to buy shares of stock at 66, buy another 100 shares of stock at $66 to average down the cost of your position to try to get a better view. Now, let's use the tools here to sort of analyze what that would look at like. I'm going to go back to the portfolio here. And remember, our original cost was $79.50. So let's go to the profit and loss chart for this particular position. All right, so there was our original covered call trade that we received that rich premium for. We were looking to make 5.5%, but now instead we're standing at an unrealized 12.9% loss on the position. Okay, so we let the call expire worthless. So what does that mean? Well, that means our cost on the stock would be reduced. So our $79.50 cost per share minus the $3.70 premium we kept would put us at a cost basis now of $75.80. And let's say with the $66 per share, let's say at some point today we could have bought another 100 shares at 66. So our total average, if we add that together and divide it by 2, that would lower our effective cost per share down to $70.90 for 200 shares. Okay, but the stock's at $66. So the averaging down would have hedged us a little bit. Now, we've got a $4 loss on the stock. One of the things that we can do is we can say, okay, well, now let's go back maybe to our 14 days out here to February. Our cost basis is $70.90. I don't want to sell the 69 call or the 68 or the 66 because I don't want to be that far out in the money. I don't want to risk getting a sign and giving up that 3% gain. The 70 call here gives us a 75 to 95 cent bid. It's closer to our current price. So if we sold that call, the weekly call, for 85 cents, let's go ahead and take a look what that looks like. You all know this is going to be a loss, of course, but that's all right. Let's go ahead and submit that. Okay, so this isn't too bad now. We've averaged down our cost, and by selling the call for 85 cents, if we get a sign now at 70, remember, still 9 points below where we originally purchased the position, but if we get a sign at 70, we'll only have a loss of $10 and 0.1% as opposed to the 12.9% realized loss we're taking now. But we didn't do anything to address the downside. If the stock continues to fall, as we mentioned, we're throwing more good money after bad. That's the problem with averaging down the position. So you may want to look to roll further out in time in this case. Another feature that's offered is on Power Options, of course, is that if you decided to go this route and double down your position, and let's say we now have 200 shares at $70.90, well, we could take a look at what that would look like, DECK, in what's called the stock repair tool. And I'm going to put in our cost per share if we average down at $70.90. Remember, we had that original price of $79.50. We lowered that down to about $75.80 with a $3.70 premium, and we bought another 100 shares at 66. So our new cost basis is $70.90 for 200 shares. Let's go ahead and submit that. Okay, so what this tool did is it tried to build a ratio repair using the available options to help us get back to break even. But as we see, there's nothing available in February that could result in a credit repair for our position, and there's nothing available for March. The first one we see is an April position, which is 77 days out in time. Now the repair details for this particular position is we of course could buy, the ratio repair works this way. We could buy 2 calls at 65 with a cost basis of 520. Well, that would be $1,000.40. We could sell 4 April 70 calls against our long April 65s for $265, so that would generate $10.60. So we'd make a small net credit of about 10 cents or $20 total, which puts our new break-even at $67.90. Well, that doesn't work. Shouldn't our break-even be $70.80 because our cost basis was $70.90? Well, here's what happens. If the stock moves back up in price and goes to $67.90, again at April expiration, remember that's 70 days out, we keep the 10-cent net credit, which lowered our cost down to $70.80. But these 2 long calls we bought at 65, right, with the stock at $67.90 and our cost basis at $70.80, we're still down $2.90. But we own 2 65 calls that'll be worth $2.90 at April expiration if the stock gets at $67.90. So that plus the 10-cent net credit we received puts us back to break even, and we didn't need the stock to go all the way back to $70.90. However, there's 2 trade-offs with the repair technique in this case. So let's scroll back up. We want to click on Analyze Trade from our potential repair. This will take us to a profit and loss chart of this ratio repair for a stock that's fallen in price. And we see that this is pretty good. If the stock moves up above $67.90, that's our break even. But if it does recover and go back above 70, again at April expiration, we've turned the potential of a 12.9% loss on the position. Oops, sorry folks, there we go. 12.9% loss on the position into a potential gain of 5.9%. And even though the stock's at our sort of cost basis at $70, well, we keep that sort of meaningless 10-cent, 20-cent net credit. That's true. But our 2 calls now are worth 5 points, which counters that loss we had on the position of $70.90 with our cost basis at $70.90. So now we get into a profit position of about $840 or 5.9%, which isn't bad for what we'd have to consider would actually be an 80-day trade, because the 10 days we've already been in the position plus the additional 77 days to April expiration. So in a lot of cases that repair technique might work after you average down, but again it's hard to advocate doing that because you may be throwing good money after bad. And as I mentioned before, the other issue with the stock repair is what? Still haven't addressed the downside. And you could add a put to this position to sort of limit the downside loss, but that's going to take away from the gain you might see in these calls and the initial credit you receive. So the risk-reward profile, this would lower, and it might only be a 2% gain to the upside instead of 5.9, but you may have limited your loss to only 4% or 5% if the stock continues to fall. Okay, so those are just some of the ideas to address when would you look to adjust a covered call. And we talked about that with BCC. One common way is to use it if the stock has dropped 80%, if the option has dropped 80% from what you originally received, or the position as a whole is at 80% expected profit from your max expected profit. If you have a large decline that breaks through your stop order, well, you may have to look to manage the position. 2 good rules of thumb for avoiding this position. Number 1, never trade a covered call, naked put, bull put credit on a stock that has earnings coming up between now and expiration. No matter how positive you are, the stock's going to go up. A better approach is that instead of doing any covered call position or a covered call strategy with earnings around or in general for long-term growth, focus on more protected positions such as a collar spread or a married put position. When you reach the point that the stock has gapped down against you, you're going to be forced with those 3 options. 1, just take the loss, liquidate the position, and try to make it back over time in other strategies and other positions that look more strong. Number 2, just buy back the call and maybe roll down the call to a lower strike price. As we saw, we could even go out to April down to the 66 or 65 strike from our original position, and in that case it would still be a loss of 4% if we got assigned in the best case scenario. That's a long-term play. We'd have to keep managing it month after month, and probably be a 7 to 8 months of management just selling calls before you can get back to break even. Number two, with a decline of this kind, possibly average down and see if there's a stock repair that could be built here on Power Options to help you get back to break even faster and still maybe make a little profit as well. But in a lot of cases with these large declines, the stock repair might not be able to find a repair technique for you as well. All right, let's move on to some of my new questions that came in while we were discussing that original one. Ralph wants to know, selling a put for income, if the stock tanks and the put gets exercised. Oh, okay, this is pretty easy. Well, not easy, but this is, we've already had most of this discussion, Ralph. Just not applied to this way. Selling a put for income, if the stock tanks and the put gets exercised, for any case where stock is significantly underwater, are there any strategies that address recovery from a situation like that? Yeah, we just talked about them in a sense. Okay, Ralph, so look at it this way. Rather than having this covered call here, when the stock was at 79.50 and we sold the 80 call for 370, what if we had sold the 80 call on Deckers, or on January 20th, what if we had sold the 75 put with the stock at 79.50? Let's go back historically, take a look at that prices for today's 75 strike put, and see what we would have gotten, and then see how we could have managed it. All right, so once again, DECK here. I'm going to go to the chain. I just want to look at the put chain for Deckers. And now I'm going to use my time frame here. All of us that are on a trial to Power Options, of course, we can go back about 2 months in time to see the historical chain and historical backtesting tools. Let's go back to January 20th. Let's take a look at our put chain. All right, so for today's, at the time, looking at today's expiration, the 30th, the 75 strike was at 215, 280. So let's call that sort of 30 cents up would be 245, 250. So let's say we could have gotten maybe 240 or 245, Ralph, for the 75 strike put on Deckers. Okay, let's go back to our portfolio. And let me enter a new position in the portfolio. So I'm going to enter a short put. All right, select the option. It was DECK. We're going to select today's date, and I want that 75 strike put. There we go. Let's say we just keep the math simple. We sold one contract January 20th, and we received $2.40 for the position. Oh, and the stock price time of trade was 79.50. So about 4 points out of the money, roughly about 5-6% out of the money at the time of the trade. Let's go ahead and submit that. All right, so now the stock's broken down to 66.05. We're about 9 points in the money. The ask price is $9.40 for our option. This is roughly a loss of about 9.3%. We took in $240 up front. We've got to pay $940 to buy it back. It would cost us $700 to close one contract. This 9.3% loss is reflected against the margin requirement of $7,500 for one contract. The $940 against that $7,500 would put us at a 9.3% loss in this position. All right, so what are some of my opportunities? Well, we could have bought it back at $940 and looked to roll down, just as we saw with the covered call. Buy it back for $940, I've got a $7 loss. I'm not going to get $7 back on the roll. Again, you always lose more on the stock than you're going to be able to make back rolling down with the option, unless you go maybe 12 to 15 months out in time. But now you're sitting on the position for 12 or 15 months before you really see any time decay to do any realistic adjustments on that position going forward. Okay, so we're going to try to hedge some of that loss. Let's go to position actions and then position analysis. As before, this gives us the profit and loss chart of our naked put, the exact same risk-reward profile of a covered call. We're down 9.3%. That's based on the $7,500 cash secured requirement for the naked put position. All right, and we're shown here that we have a couple rollout. Tried to calculate some rollout opportunities for us. Since our put is ITM, we could buy to close it at $940 and sell to open the following put. We're going out of the money. This 73 is only 20 cents. I'm sorry, we could get 720, but that's a deep in the money put. I don't know if you'd want to do that based on your expectations. See, this puts you at a positive credit, but you're so deep in the money now that you're probably going to get assigned for another loss. And what he tried to do here, this other rollout opportunity it tried to do, is it tried to show you that if you allowed yourself to be put the stock, bought the stock at $75 minus your premium, of course, that we originally took in, that $240, so we'd have a cost basis of $72.60. It tried to find a covered call that you could sell to get back to a positive % return But we're not seeing anything here because nothing that's available right now gets you to a positive return for this naked put position. This is an extreme example, but the concepts still follow. So again, what is one of the other things that I could do? Since I don't see any rollout opportunities here I like, let's go to the what if calculations from that position analysis screen, and this shows us our original position. Now, let's say again, we didn't close the position in time, so we're going to get put stock at 75. But with our premium of 240, we'd know we'd have now 100 shares of stock at 72.60. And the stock's currently trading at 66. All right, so the 240 we collected minus that would be my cost basis for the shares of stock. If, again, as we saw before with that covered call position we looked at earlier, or the repair technique, if I tried to average down now, if I thought this was an over-exaggeration and, might still drop another point or two, but I think the Deckers is going to come back over time. It's a tough guess, but, So we buy another 100 shares at 66, so our 72.60 again, a little bit different price than we had from the covered call. We take that divided by 200 shares, we'd now have a cost basis of 69.30. So what that comes out to, of course, is the, let me draw that out there, 100 shares at 72.60 cost basis, of course, averaged with the $66 for 100 new shares. We're just going to ignore that 5 cents that's there. So that would have been 138.60, so the half price of that would be 69.30 is our new cost basis for 200 shares. Sorry, 69.30, the average between the two. I should have divided by 2. Okay. And so anyway, that's my new cost basis, 69.30. Let's change that to 200 shares. Could I sell, perhaps with the stock at 66, could we go out 14 days and maybe sell a, much better, 69 calls at 90 cents or in the 68 calls at 115. So that wouldn't, could we do that? Well, maybe it would be close. No, it's going to be under, I'm sorry. So if we sell the 68 call for, let's say, 140, there's a wide bid-ask spread right now. Let's sell 2 at 140. All right. Okay. Okay, Peter said, well, Peter, that's the other question. I think I've already addressed that as well, but hold on one second. Peter says, sorry about the gaps. Okay. So now, if you sold the call here for that 140 we used as a price, well, you'd have a positive return if you could assign it 14 days. Not a good return, but again, it's not that loss we were looking at even after getting put the stock. Peter's question was, why not just buy a put to protect the stock? Well, Peter, absolutely. You know me well. You know that that's what I do in my account. I avoid the risks of taking these losses with naked puts and with covered calls by usually entering a married put or a collar position with about 60 to 70% of my trading capital. I don't do covered calls anymore. I don't do naked puts because I've been caught with too many of these positions over time. And not even that I'm a poor stock picker, but look at that loss we saw in the first one for that first Deckers covered call. The unrealized loss of 12% on the position, or if it was closer to 13%, if I'm only making an average of 1.5 to 2 or 2.5% per month premium, a loss of 13% is going to take me 6 to 7 months of selling that same premium to get back to break even. That's over 50% of your trading year dedicated to just adjusting one position to help try to turn it into a profit. You're making small profits on the upside. If you take a significant loss such as this, it's going to take you many more wins just to get back to break even. Now, Peter, is this a good time to enter into a put position now that the stock has dropped? I've got a lower cost basis because I tried to average down, which honestly, Peter, I don't advocate, as I mentioned, because we might be throwing more good capital after a bad position or into a bad position, sort of catching the falling knife as the axiom goes, trying to catch a falling knife there. If I don't insure the downside, I can absolutely see more losses and be losing more capital because I've increased my share even though I tried to average down in price. The repairs we're talking about, Peter, are premium generation, and it's talking about trying to get back to break even after an event has happened. If I did feel, Peter, and I discussed this a little bit, but if I did feel now that I'm in this position, I've averaged down perhaps and my cost base is 69.30 and the stock's trading at 66, but I feel long term over the next 5 or 6 months that Deckers is going to come back and should be trading at around probably $74, $75 per share sometime in the next 4 to 5 months after the next earnings cycle. I think they're going to recover. I feel strong on this stock and this is an overreaction, absolutely. I might add that 6 to 8 month output on this position now. It's going to give me a higher risk, though, because I have to factor in the loss of $3 already plus whatever time value I'm paying into that farther out in time put option. So I may be still looking at a large risk of 10 to 12%, but that's the worst case scenario now going forward. All right? So we've locked in that we can't lose any more in that position. Let's take an example here of what I might do. 150 days. Let's go to June. It's close. I'd like to go a little bit farther. My target price maybe for this stock recovering is around, let's say, $76, $77 per share in the next 5 months, 4 months or so. So let me look at the 75 put, 1140 to 1220. So that would put us at, the midpoint would be about 1180, 1190. So let's just say 12 even. So I'm going to buy 2 at 12. All right, so what do we have? I have stock at $69.30. I'm buying a 75 put for $12. So my total cost base is roughly going to be $81.30. So the most I'm going to be able to lose on the position is going to be $6.30. Should come out to about 7.7%. So now we've got a married put position. The stock is down here, of course. We'd want the stock to be trading maybe a little bit higher. Break even, of course, at expiration is 81.30, but we have a wider, lower break even here. But maybe now that we have this protection in place, we can start looking at other adjustments. So now if the stock continues to fall, I've at least guaranteed that I can't lose more than 7.7%. Much better, Peter, as you mentioned, as almost a 13% loss I'm at right now if I just liquidated that covered call position that went against us without averaging down. Okay, so, and then premium going forward, well, we'll probably need to wait for the stock to move back up before we did something that would still give us a good return and risk-reward profile. But I agree with you, Peter, but it's not so much in the sense of adding a put to it now that it's happened and the stock's been put to us. I prefer to use the put in the first place rather than allowing this loss of 13, 14, or 15% to take hold of my account and cause me to have to manage the position for an extended period of months. Okay? All right. Here's a trickier question that comes in, and it comes in from Vaughn. Vaughn wants to know, can I generate a weekly income just by buying puts and calls? Well, can you generate a weekly return by just buying weekly calls and weekly puts? Yes, if you pick right, but it's going to be much harder to accomplish. You're going to see a rapid time decay of anything you buy that's only 5 to 7 days out. Most investors using weekly options are not buying calls and buying puts. Okay, they're selling premium. They're doing income strategies such as bull put credits, bear call credits, iron condors. These, of course, the problem with the weekly options in those strategies is that you're receiving a lower net credit, a lower premium up front, and what that means is that you're taking a closer to 15 to 1 or 12 to 1 risk-reward ratio. So if you lose the full amount on one bull put, you've probably wiped out 12 previous gains you might have made for the weekly put series because you're only collecting a credit of 20 to 30 cents with maybe risking 3 points, 4 points, or 5 points on the bull put or bear call credit spread. Naked puts, of course, the cash secured puts that we looked at earlier, selling a put, but that takes the risk to the downside if there's a large decline. Shouldn't be doing a credit spread and income strategy such as a credit spread, covered call, or naked put position on a stock if you have earnings coming up between now and expiration. Can you make a profit by just buying calls and buying puts that expire in 5 days? Yes, if you see a gain in the stock position that matches what you want to see. Okay, if it does go above your strike price. If you buy cheap options that are out of the money, you know you need a much larger gain in order to get to break even. Okay, let's just go back in time once more. I'm going to take out some of these two strategies. Let's add in long call and let's add in long put. Okay, now can you generate income against these positions if you just bought a call that expires in the next 10 days or 9 days to next Friday's expiration or a long put? No, you can't generate income unless you sell something against it. You convert it to a credit or a debit spread based on your sentiment on the position. So can you make a profit? Potentially, but you got to be right more often than you're wrong. You've got to pick positions that are successful over time or stocks that decline if you're doing the put series. So let's look at a long call. And again, actually, let's go back to the historical testing. We're going to go back to the historical testing here. I'm going to go into the Smart Search. And let me go ahead and do a long call screen. And we're going to go back to January 20th as we did before. And I don't have a weekly screen. So let me just check this My Long Calls and submit the search. These are for options that are further out in time. But we're going to make a change on the fly to this historical screen. Now it takes a little time because it's processing the historical data from the close of day today. So it's going to run our results here in just a second. There we go. Now as you can see, the basic view of a long call trade, Vaughn, the common use of a long call and option selling, these income strategies we were talking about before, relates to the general concepts of options. And what I mean by that is that if you look at any option chain, your options that are 4, 5, or 6 months out in time at the same strike price, just look at the at-the-money options in a given stock. The options that are 4, 5, or 6 months out in time are not going to be 4, 5, or 6 times the cost as the current at-the-money strike. Okay? So when you go further out in time, the cost per day or the premium per day is much lower. It's just like your insurance for your car or your house. If you pay month by month by month on your car insurance, you might pay $1,200, $100 per month for the course of the year. If you tell your insurance company that you want to pay the 6-month premium, you might only have to pay $1,100. But if you pay the year up front, they might give you a discount and you only have to pay $1,000. Okay? Options are kind of the same way. If I buy further out in time, it looks like I'm paying a high cost. Here's from the 20th, of course, Flowers Foods at 2009. The out-of-the-money July 22.5 call was priced roughly at only 40 cents. That's an out-of-the-money. Do I have an in-the-money here? Doesn't look like I do. Okay, but so that's priced at 40 cents. But closer in time, the 22.5 option probably would have cost 20 cents or 30 cents. You know, not 1/5 of the time that we're looking at here for 5 months, 6 months out in time. It wouldn't have been 1/5 of the cost, so it's only been 8 cents. Probably would have been 20 or 30 cents. So what that means to us is, as option sellers, I want to be selling in the shorter term, either week by week or month by month, to maximize my annualized return. And as option buyers, whether I'm buying for insurance in a collar or married put position, or buying speculating with a long call or a long put position, I typically want to be buying further out in time to A, give the stock more time to move in my desired direction, and again B, so that I'm paying less cost per day. The upfront cost is higher, but the 40 cents for 178 days is going to be a much lower cost than the February 22.5 call that was probably 20 or 30 cents for 30 days. Okay, so let's change some of our criteria here. I don't have to worry about the strikes in or out of the money. The option ask price less than 5 is good. Bid ask spread less than 50, that's good. I leave my stock criteria here for the time being, but let's change our time frame so that on the 20th, we would have looked for any expiration that was, let's say, 2 to 12 days out in time. So we would have looked for weekly options. And there, we've got too many in here. I've got the January 23rd. I've got to filter this out, so let me push this up to 4 to 12 days out in time, so we just see the 10-day out long calls that match this other basic criteria. So there were a total of 16 call opportunities. There's duplicates, okay, Verizon, Oracle, Gilead Sciences, and so forth. Let me change this a little bit. We're going to just look one result per security, so we don't see the mixes there. All right, so based on that call criteria, we wanted to look, let me just show you that real quick one. I was looking for stocks that have greater than 500,000 shares on average traded per day over the last 90 days, stock price greater than the SMA 50. I only want to see stocks that have grown 7% earnings from last year this year, and I'm keeping a PE ratio between 0 to 50. So the stock price is in an uptrend, has some good liquidity, positive earnings. We want to see some volume and open interest on the options the day we ran the search. Really, our only requirement is the ask price was less than $5. We want to keep it around at the money, and we're looking for options that are not too much overvalued or undervalued based on the IV-HV ratio, the implied volatility divided by historical volatility, less than 1.05. All right, so here's our few results here, 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 results for weekly calls that match that criteria from January 20th. Now let's go ahead and calculate group results, and let's see how these performed today. Of course, you might have done some management in between the time you entered the trade and today's expiration. That would be based, again, on the trading plan that you set based on your risk-reward tolerances. Holy Hannah. Of course, this was a bad market to do it in. But look at this. Of our 9 results that we had there, sorry, folks, was it 9? 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, of our 9 results we have there, only 1 of those weekly calls resulted in a profit, at 11.1% gain on Potash. The stock was at 35.62. The January 36 call was at 45. The stock ended at 36.54, so we could have probably closed the position for 50 or 55 cents, made 11% yield. Every other call expired worthless. Well, that's because of market conditions. Okay, so we know that would have happened. We were right 1 out of 9 times. We only had 11% success rate. The average return was a loss of 85%. Depending on how much of your portfolio you put into these 9 or 10 positions during this given week time frame, you'd be looking at a very significant loss. But okay, it was market conditions. Okay, and this is just a set search. I'm just using this as an example. Let's go back to where we were before in a smart history view, but let's go to long put. I'm going to try to back test some long put positions. Let's go to Smart History Excel once more. Long put, January 20th. And again, I'm just going to start off with this base criteria called initial value set. All right. Now, let me look at the criteria. We're keeping it within 1 to 1. We want to look for undervalued options, delta right around the money. I'm going to add 1 result per security, but we're going to change the time frame. I'm going to go all months. Let's go 3 to 12 days again. Okay. Looking for stocks trading below their 50-day moving average. Not a good broker recommendation. Stocks that are down into the lower 30th percentile, their 52-week range. So we're looking for some bearish fundamentals on this particular screen. Let's run our search for January 20th again. And we had 36 total results, and I did limit it to 1 security per result. Right. Did I? Oh, I did. Okay, I apologize, folks. Yeah, I wanted to make sure that I enabled that as well. 1 result per security. Okay. So here's our top 15, and it's sorted by the highest stock price. So the lower stock prices would have been our other 16 results there. All right, so here's our top 15 results. Let's see how these would have done from January 20th today, knowing how the market performed. These were stocks that were already in a downtrend. Oh, good grief. So stocks were already in a downtrend that had been performing poorly and had decline in price. Tesla, Zillow, ExxonMobil had been in a downturn, Hess, Coors, and so forth. Well, this is just as tragic, isn't it? You had gains of 92%, 100%, 216.7% gain on CBI. The stock was at 38.94. If you would have bought the 38.50 strike put on January 20th that expired today, it would have been 120. Could have closed it today with a stock at 34.51 for 380, but it wasn't nearly enough to counter all of the other losses you would have taken. Okay, and this isn't even such a factor. Some of these positions did not move that much. 191 to 203. Okay, so that's a 6-7% move for Tesla. Zillow went from 95.85. Okay, so on January 20th, Zillow was at 95.85. The slightly in the money put at 96 was at 360. And the stock moved up only about $1, 96.92, not a large move, but that caused you to have a 100% loss on this put. It would have decayed rapidly. You would have seen that time value evaporate quickly on this position, and you didn't really get any results. ExxonMobil did return a profit, 91.09 at the entry with a January 91 put at 156. Stock at 87.42, closing price at $3, so a 92% gain. But those 3 gains, 216%, 100% gain, 92% gain, were not enough to counter this position. And so what about management? Well, that's what makes it difficult with trying to use long options in the weekly series, is because you don't have enough time to really manage. As soon as you see a 50 or 20 or 30, 40 or 50% loss in the position, which might happen over a day, 30% on your option, not on the stock. You might see that in a day. You may have to close it to try to retain as much capital as you can, minimize the loss to only 30 to 40%, and then try to buy another call or another put, depending on your sentiment, the next expiration or 2 expirations, 14 days, 21 days, or further out in time. Now you've put more money in, but you need to get more of that time for the stock to move in your desired direction. Don't advise trying to develop a strategy. I've not seen it able to work, but developing a strategy where you're buying calls and puts with the weekly series. So what if the cost is lower because it's a weekly series? I don't think it pans out over time. They move against you too quickly. You don't have enough time to effectively manage those because you're losing more of that premium rapidly when you're only in a 4 or 5 day trade. So I just don't think it's a good idea. But that being said, we have a follow-up question. Jerry wants to know, how would it be selling a naked put while buying a far out put at 5 points above the naked put selling price? Okay. Weekly option at the same time or stock assignment. Okay. Now, Jerry, I think, let's see, how would it be selling a naked put while buying far out put at 5 points above the naked put? And we talked earlier today, Jerry, during the coaching session. I know what you're kind of looking at. Okay, so you're talking, I'm sorry, I was looking at, you're talking about a weekly calendar spread. I have a problem with this, and let me show you why. And this is something that we didn't touch upon today, Jerry, because we spent a lot of time trying to get your positions into that portfolio there and get it set. But let's go back to square one, okay? And I'm just going to go to the custom spread tool now rather than going into actually, no, I'm going to do something else here. I'm going to go to the portfolio. Yeah, this is where, no, this is not where I want it to be. I'm going to go to the RadioActive trading ones. I'm going to pull up something real quick. My latest married, no, that's not it. I haven't even entered it. My apologies. Okay, no problem, no problem. Let's just do this here. Let's go back to custom spreads, sorry. And I'm going to type in BCC. And I'm going to show you what I did a few weeks ago. I don't remember my exact price, but let's use the prices today. BCC today is at 40.54 roughly. And I could go out to July, 168 days out. 45 put, 570 bid, 690 ask, $1.20 difference. Let's call it 60 cents to midpoint. Let's call it an ask price of 630. Okay, so here's what I opened on BCC. It was a little bit different prices. My risk was a little bit higher, around 4.5%, I think. But in any case, bought stock at 40.54. Bought the 45 put 5 months out in time for 630. So my total investment is 46.84, guaranteed to get 45 back. So we have a risk of 3.9% to the downside. And the stock's at 46. I'm sorry, the break even's at 46.84. That's at July expiration, not today. See, my break even at the halfway point on April 27th is sort of only around $42.50, $43 per share. Okay, so the put's not going to decay, and it's not going to go to zero as soon as I open this trade. It's going to retain most of its value. In fact, if the stock moves up 20 cents or 30 cents on Monday, I'll probably be able to close the position for a 10% or a 10-cent gain, not 10%, 10-cent gain, because the put will decline 20 cents. The stock might go up 30 cents. Well, liquidate it and take the 10-cent gain. Okay, it's not going to go to zero. I'm not losing this 630 as soon as I buy the position. Now, what you're talking about, Jerry, is why buy the stock? Why even bother putting together this stock position at all? Instead of buying 100 shares at 40.54 and putting out a total cost basis just for 100 shares of $4,684 worth of capital, why don't I sell? Well, this one doesn't offer weekly options, so I might have to use a better example, but you'll get the point here. Why don't I take that out, and why don't I sell the February, 3 weeks out in time, 40 put, 70 to 125, 55 cents, let's call it 50 and 25. Let's say we can get 95 cents for this short position. Okay, sell 1 at 0.95. All right, let's go ahead and run that. Now, we've got a leveraged return. We can make a max return of $105, okay, if the stock is trading right at $40 at expiration. If the stock is trading above $40 per share, our short put, this February 40 put, expires worthless. We keep that 95-cent premium. We lower the cost basis of our 45 put. In fact, our debits now is only $5.35. That's our cost basis into the position. But if the stock moves up to 43, 44, 45, or 46, our loss is in the upside, okay? So what could happen here? Well, if let's say the stock gaps up to $46, your short put expires worthless, excellent, or it goes to zero quickly, excellent as far as that goes, but you're losing so much money on the long put now, right? This is going to lose $3 to $4, and it's a leveraged return, of course, because you're trying to use leverage on the position. So what's the benefit? Let me go back to the other screen. What's the benefit? Let's say the stock is trading right at $46 at February expiration. So use a calculate group results here. $46. Our original investment was $5.35. The cost $6.30 for that put. The 95 cents for the 40 put we sold against it. The at the money put we sold against it. This creates a calendar put spread. And we could have made 105, which is about a 20% leverage yield, but now that the stock is at 46, theoretically, we're going to lose $322 on our call, but we keep, our long put, we keep the 95 cents. We've got a loss of 227, roughly 45% of what we invested in the position. Okay, so that's leverage working for you and leverage working against you. Did you put in less capital? Absolutely. I'm not going to argue that. The real problem I have with this is not so much the leverage. You've got to be comfortable with the risk reward you're taking in a spread position such as this. The problem I have with this approach, Jerry, let me go back here and let's do that other position again. When I open this type of position, let's go back to our married put July, blah, 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 45, and I said 6:30? Yeah. Sorry, folks, 6:30. Okay. So when I enter this position, I'm entering into a limited risk position where even if the stop gap's down to $25 per share, I can't lose more than 3.9%. I've got the infinite upside profit potential. In this case, with just the married put, if the stock goes up to $46 by February expiration, which was the 20th, I'd have a gain of $223 off of an investment of $46.85 instead of a loss of $220, which was 45% of my $535 investment. When I open this position, it's because I'm neutral to bullish on the stock. Every time I open a married put, radioactive trade is with the expectation that I feel comfortable the stock has the chance to move up 5 to 8% in the next 30 to 60 days. This idea of selling the put to get in the stock at a discount while keeping the same protective put in place is trading against myself. A lot of investors who look at the married put technique, the radioactive trade, say, oh, why are you trading against yourself? You're buying stock you're bullish on, but you're buying a put too. You're trading against yourself. No, I'm not. I'm ensuring a large investment with a lower price, still leaving my upside open. That's not trading against myself. That's protecting my full investment and leaving my upside open. When I try to sell a call in the married put too soon, or if I try to do this idea of entering into a married put by trying to get the stock at a discount by using the calendar put strategy, now I'm trading against myself. Why do I say that? Well, because I spent all that time researching and analyzing a stock that I felt had the potential to move up 5 to 8% in the first 30 to 60 days. I've entered a position that's going to reflect the loss if the stock matches what I expected to happen in that first 30 to 60 days. How is that of any benefit to myself? If the stock ends up trading right here, at this price of $40, it's a gain of 105, okay, and then you might be able to buy stock at $40. You kept the 95 cents. Now you have a cost basis of $39.05, okay, for a married put position. Is that better than the position I'm in? Well, yeah, but then what's the other outcome? Let's go ahead and put that in. I got to clear this out once more. I'm going to put in the stock. Remember, if we got put stock at 40, we'd have 100 shares. Your cost basis would be $39.05. The 95 cents minus our 40 strikes. We're put the stock at $39.05. We had the July 45 put in place already at 6:30. Okay, so now you've got a risk. It's almost bulletproof. That's fantastic. Okay, I agree with you. That's fantastic. You've still got the unlimited upside. You've got little to no risk on the position. That's great. Now, let me ask you something. Let's go back in. Sell our February 40 put. Sorry, there. It was at 95 cents. I'm not saying that you're not a better stock picker than I am. I have several customers that use Power Options that are better at picking stocks and timing trades than I am. However, this type of strategy to try to get into a radioactive trade only works in one scenario, and that's if you can consistently pick stocks that move up or down, or plus or minus, move, terrible writing, I know, it's hard to do with the pen on the screen, move plus or minus about 1% for the first 30 days, but then we'll move up the 5 to 8% over the next 60 days after those first 30 days. If you can pick stocks like that on a consistent basis, this will work out for you. When I first ran into Kurt at Radioactive Trading and he showed us the married put techniques about 7 years ago, the first thing I did was say, well, that's great. I see what this guy's doing. He's putting a lot of capital into it. I could do better. if I tried to get into a married put trade by doing exactly this, selling the at-the-money put, or, doing an in-the-money long strangle where I'd still buy this 45 put that was far out in time, but why not buy the 30 or the 35 and create an in-the-money long strangle position here like this. And what I found out is the problem with this is that, and we saw that today, I believe, Jerry, with one of your positions, it's okay if the stock moves down because you get put the stock, but now if the stock's at 35, if it gaps down quickly, the stock's at 35, you got put the stock at 40, you've got a lower cost basis, you've got a slightly lower risk now, but it's still going to be hard for you to manage the position. You'd have to look to maybe adjust the put or do other things. Now, secondly, in relation to what happened to me more often than not, because unfortunately I have this, I'm usually right about 60% of the time, meaning I usually pick bullish stocks about 66 to 70% of the time that move up at least slightly, 2% or 3% when I enter a position. But in this case, when the stock moved up to 2 or 3%, or I got lucky on one or two and they gapped up 15%, I actually had a loss on this position that was designed to help me, whereas if I was in the married put position from the beginning, I would have had a profit and I could have bulletproofed it in one move rather than realizing a loss. So if and only if you're trying to do this, if and only if, you can pick stocks that won't move up more than 1% or really 0.5% plus or minus in the first 30 days, but then after that will move up 5 to 8% in the next 60 days to 70 days, this would work out for you. Otherwise, what I found in my portfolios, it's always better for me to do the married put position from the beginning. I always end up with better results. Oh, by the way, that in-the-money long strangle, I mentioned with trying to buy the in-the-money call and then buy the same put I'd use for the married put position. In normal market conditions, if the stock was up 3, 4, or 5%, I'd always have a gain on the married put to the tune of 2 or 3%, whereas the in-the-money long strangle would always be at a loss. The in-the-money long strangle only works better than the married put if you're consistently entering in stocks that gap up 12 to 15% in the first 30 to 60 days, or gap down 12 to 15 to 20% in the first 30 to 60 days. There's no free lunch, and leverage doesn't always work the best way for you. Lower cost does not always mean a better trade, and it does not always mean that you're in a better position. What's really important is making sure the graph, the profit and loss chart, and I'm not saying you won't be successful with this, Jerry. Don't get me wrong, okay? I know it sounds like I'm harping on this a little bit, but I'm not saying that this can't be a successful position long term. But this graph has to match your expectation for the stock, and you can see it right away. This strategy, this initial setup, I need the stock to be trading in this range to realize a profit. If I enter this position on a bullish stock, this is a bearish strategy. This is a bearish profit and loss chart, essentially. It's a neutral. It's more neutral than anything. I apologize. It really is more neutral. But it actually is bearish because you lose less if the stock collapses. If you're doing this on bullish stocks and you start to pick good bullish stocks, you're going to be losing money consistently and be forcing to manage this position. And you could say, well, okay, maybe that's not a problem. We sold this put for 95 cents, the 40 put, so as you get close to February 20 expiration, if the stock's at 43, I can buy this back for 5 cents, and maybe now I can sell the 45 put for another $1. Okay, so you got 90 cents on the first trade. You're going to receive $1 on the next trade, so you take in $1.90 from your option premiums, but at the same time, the stock's trading around $44. Well, the stock's at $40 right now, so you missed out on $4 a gain, or roughly $2.10 if you would have just been in the stock from the beginning. Again, going back to what we talked about with the covered calls, the same approach works when you short a put, or when you're shorting another different call for a different leg. As the stock moves up in price, you'll always, on a covered call and a naked put, you're always going to give up more on the stock gain that you're missing out on because of the capped gain of the short put or the short call, the obligation of the short call, for example, in the covered call position. You're always going to be losing more on the positive stock gain than you can make back with the call premium. It's just the nature of options. If I take a $5 loss on a call, I sold it for $1, it now costs me $6 to buy it back, I might be able to roll and get a $5 premium on my next call, but I've got to go out a year to 18 months out in time. Now I know I'm going to be sitting on that position for a good 15 months or so before the time decay starts working in my favor. I'm just be sitting on that position to try to get it back to break even. Not always the best approach to roll out that far in time to try to roll for a credit. Okay, it's not always the best approach unless you're really comfortable sitting on the position, turning a 12% loss to a 1% gain for a 15 to 18 month stretch where that capital is doing nothing in your account but just sitting there hoping for time decay to get back to break even. Okay? And at the same time, if I roll in a covered call that far out, the stock could continue to drop. Same thing with this position. If the stock moves up, I'm missing out on the premium. I keep trying to roll to catch up to the gain in the stock price. I'm missing out on money, 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 money. Eventually, maybe the stock gets put to me. But now if it's at $60, the stock gets put to me. I hedged it by $3 on the position. I didn't really make as much as I wanted to do. And that whole time, my long put that I purchased is decaying in value as well. So the most important thing out of that, Jerry, is this is what you're looking at when we talk about selling the near-term put. The same risk-reward profile would appear if we were doing this as a weekly. This just happens that this stock, we use as an example, doesn't offer weekly options. So we're looking at the standard February expiration. But your risk-reward profile would be the same. Only problem is you wouldn't be seeing 95 cents for a weekly option in this scenario. If I sold the 10-day on option that expires on February 6th on this stock, if it was available for the $40 strike, I'm probably only seeing 20 to 23 cents against my cost of $6.30 for the weekly series. Okay. My apologies. Okay. All right. So that's just where we want to talk about there. So Vaughn, related to your question, I might highlight this in a different presentation, what we showed today regarding the long options for the weekly series, just to make that more clear in a more clear presentation just on its own. But just using those criteria that we use, you know, we were looking for negative stocks that had good option premiums and were undervalued for the puts. We were right only 11% of the time. On the call side this last week, it was even worse. The market was down, but the puts didn't even help us. Some of the stocks were up. Some of the stocks fell, actually declined in price, and we still took close to a 90 to 89% loss on the put position because of the time decay for that weekly series. Kind of difficult to do with the weekly options, just buying calls and buying puts weekly to make a profit. You're better off buying further out in time, giving the stock more time to move in your direction, and also not to decay as rapidly against you. And then in relation to Jerry's question with the put premiums, you know, selling the put and buying a far out put is great, can work for you. The calendar spread position may be able to work out for you, can work out for you long term if you pick the right stocks. But remember, when you get into the stock position, if you're looking to try to get into a married put at a discounted price, calendar spread isn't the best way to go unless you can consistently pick stocks that only move a small amount in the first 30 days and then do go the direction you want. You're trading against yourself. You're entering into a bearish position to trade a bullish stock, and that's very risky long term. All right. Well, ladies and gentlemen, I don't see any more questions coming in. We're roughly at about 5:45 p.m. Eastern Time. It's 5:43 p.m. Eastern Time, as a matter of fact. If you have any last-minute questions, go ahead and send those in. But I just wanted to remind everyone, you know, how can you get these tools that we use today to showcase the risk-reward profiles, historical search analysis, historical searching flexibility. If you haven't done so already, make sure you register for the 14-day free trial. Just go to PowerOp.com, and you'll see the link there to put in your first name, last name, and email address to register a 14-day free trial. Our subscription services beyond that, the 20-minute delayed service is only $60 per month. We do offer a 20-minute delayed with full access to our 8 or 9 years of historical backtesting data that we saw a little bit of today. That's only $40 more, so it's a total of $100 per month as well. The real-time service, anytime you submit a search, refresh the page, or reload the portfolio, you're getting the numbers and calculations. At that instant, that's $100 per month. And then, of course, the upgrade to the full service, the real-time tools, real-time service, plus full access to the historical suite of tools and historical chains is $140 per month, but there's also discounts available at the end of every cycle. John asks, how do you trade earnings with options? Well, if I'm in a stock position, if I was in a covered call, I'd protect it with a put. If I'm in a bear call or a bull put credit spread, I'm probably going to adjust the position before the earnings, not necessarily convert it to an iron condor or maybe some kind of butterfly that leaves the upside open. Let's see here. Am I back on the other screen, John? No, I'm not. Okay, hold on one second. Probably the most popular way to play earnings, if you're looking for a quick buck and you're willing to risk 100% of what you invest into a leveraged options play, is going to be the long and short straddle or strangle. Okay, so let me go to other straddle. I'm sorry, just the longs. I said short. I apologize. Just the long and short straddle. So long straddle and long strangle. Let's add those in. So the long straddle, you typically buy an at-the-money call and at-the-money put, and if there's a gap one direction or the other, you're looking to make a profit. This will be a good example. I think I'll stick with this for just a moment. Long strangle is you buy an out-of-the-money call and an out-of-the-money put just to look for a profit. Now, on both of those strategies here, I wanted to show you something. There's a link here, a text link here for a free white paper on power options. So if you go into the long strangle or long straddle menu, there's that link there for using earnings surprises for straddle and strangle buying. This is something Ernie put together a few years ago. I'm pretty sure this is a public page, but let me test that for you very quickly here. In other words, you can access this without being logged in. I'm going to make sure. Okay, good. Yeah, okay, so here's what I'm going to do. I'm sending a chat window to a message in the chat board. This is the link for that straddles and strangles paper that Ernie put together. Now, that being said, I don't know if we'll have time to address it today because it is 5:45. Well, let me try to do it real quick. Let's go back in that same time frame, and let's go into long straddle, and let's go into now let's go strangle. This is the out-of-the-money one where I'm trying to spend less by buying an out-of-the-money call and out-of-the-money put. Let me go to long strangle, and let me go to back test. Okay, and I'm going to search by symbol, and we're going to go back to January 20th. Okay, and we're just going to look at the January expiration, so the near term. I'm going to look at more results. Let's see if we can find anything on DECK. Remember on January 20th, DECK was around $75, $76 per share, right? $74.90? Is that what we were looking at earlier? Let's see if I can get all results here for January. Maybe I'll have to go to February to do this. Let's go to February. Okay. So these are the ones, the weeklies that are the 20th of February. I'm sorry, the standard expiration for Deckers. Maybe Deckers doesn't offer weeklies. I thought they did, though. Yeah, they had to. We ran that example. My apologies. Oh, in any case, here are some of the straddle and strangles. With the stock at 79.16, we see an example of far out of the money 92.5 call and the 70 strike put. But look at these prices, $1.75 and $3.20. That's probably the best one. Well, not the best one, but that's the one with the lowest cost there, looking at the strangle position. Okay? Oh, sorry about that. I was just looking at something real quick. There we go. Okay, so here we go. We see the 92.50 call was at 175. So on January 20th, earnings coming up in a week or so, we could have bought the, oh, I'm sorry, the total net debit was 320. My apologies. It was 145 for the 92.5 call and 175 for the 70 put. So a total debit of 320. So we're expecting the stock's at 79.16, and we saw over an 18 or 19% drop, almost a 20% drop on Deckers in this position. So this strangle would have to be profitable, wouldn't it? Let's calculate group results and see. Remember, this was the 92.5-70 spread. And it's not at expiration yet, but we're just looking at where it is today. Okay, so we bought that out of the money call and that out of the money put 10 days out in time, about 10 days after, 20 days after the earnings come out. Bought it 10 days before earnings. We saw the debits there. Okay, and there's some decent gains here. The 92.5 and the 70, well, the 92 is going to go to 0, right? The stock's down at 66. And the long put is worth $4.70 right now. Our 70 strike put with a stock at 66 is priced around $4, $4.70. We still have 2 weeks to go to expiration. So even with that 18 or 19% gap, you made $1.50, which is good. It's a 46.9% yield on that 320 position. Okay, but you need that gap. You needed that 20% gap in order to do it. So here's what that article, that text link I sent you with the article there, John, in the chat window. What the article discusses is it's not a good idea historically that when you have earnings coming up to buy an option, I'm sorry, to buy a straddle or a strangle that's closer in time. Even though it looks like a lower cost, it's better to buy it further out because you don't see as much effect and you don't have as much volatility crush once the event happens. So if I go 4 or 5 months out, even though this earnings may have done what I wanted to do, the volatility crush doesn't affect the options as much, and I still can hold the position for another 2 months, 2.5 months, and cross another earnings event, which may also yield a profit, especially if this first one did nothing. You know, one of the stocks I'm in right now, I just forgot it, SWI, Solar Winds. They had very positive earnings come out yesterday. It was around a $40 stock or so, or $45 stock. They had very positive earnings come out. Their expectations were raised for next quarter, and the stock moved down 50 cents today. Originally, it had moved up almost $1, but because the market was being pulled down at the beginning, it moved down 50 cents. If it wasn't for the earnings, that stock probably would have lost $1.50. right? But in that case, that was a strangle that wouldn't have done you any good, right? Because in that situation, the strangle on that position wouldn't have gained or lost anything. So if you're in the shorter term strangle on SWI, you would have seen no profit or loss. You would have lost the volatility. You'd be at a loss for your strangle position. But going forward, you still could have another position there. I apologize. You could have another position there as well, another cross of earnings to realize a profit. Okay, so take out that link. That's what we sort of recommend there when looking at an earnings play going forward if you're not in the stock. If you're in the stock, I'd protect it with a collar position or a short-term married put or a longer-term married put if you're in the stock and earnings are coming up as well. Just selling a call against it doesn't give you a real good hedge. All right, well, it's 5:51 here, but last thing, very quickly, custom spread, I'm sorry. Stephen asked a question. It's related to the married put. Bought shares of that stock we were talking about earlier, BCC. I have high hopes for this one. I did have high hopes. It did do exactly what I wanted right off the bat, but then it pulled back too quickly. Wasn't comfortable with doing any kind of income methods or selling a call just yet because earnings are still coming up. But your cost on BCC was $38.80, Stephen. And at the same time, we're going to go ahead and buy a July 40 put similar to the one I did at $4.20. Perfect. This looks like the same position I have open in my real account that I showed to Fusion subscribers. Okay, so buy one at $4.20 because the numbers are nice and round. I like this one. Total cost basis into the position is $43. We bought a 45 put, so we're guaranteed to get $45 back no matter what happens. So the max risk is $2 or 4.7%. That's wrong. Oops. You bought the 40 put. Let's try that again, shall we? That would look much better. I apologize. We bought the 40 put. Yay, at $4.20. Tell it's Friday, right? It's the end of the day. Okay, so that's better. We do have that easy number, $3 maximum risk or 7% on the position. Perfect. Okay, now, I just don't understand the guaranteed return on the in-the-money put. Well, the guaranteed return is just when you bought this put, this is a guarantee. This is a contract that you bought. You own the right to force someone to buy your shares of stock from you. You can put the stock to someone, force them to buy it from you at 40. That's the obligation of the put. The rights you have as a put buyer. You can force shares of stock to someone at that price. When you buy a call, Stephen, you've bought the right to buy shares of stock at a set price. So if I bought a 50 call for $2, I have the right to buy that stock from someone at $50 per share, someone who sold me the covered call. But with my cost basis at $2, once the stock goes to 53 or 54, it's probably when I'm going to exercise my call. The put's the reverse. You've bought the right to force someone to buy shares of stock from you at $40. This stock could drop to $1 per share, and you could force someone, whoever sold the 40 strike put to you, as we saw that naked put or that calendar put position, someone sold that 40 put, you can exercise it, and they have to buy your shares of stock. These shares of stock are bought from you at $40. Yes, you had an investment of $43, but you get 40 back, so you can't lose more than $300 per share on the position. That is the guaranteed exit of the put option, even if the stock's trading at $1 per share or 50 cents per share. You don't lose that. You've got that right. Now, in general, if the stock drops, let's say 32 or 33 tomorrow, I wouldn't and I decided that the stock doesn't have any potential to come back up, I'm not going to exercise the put. Because I bought a July put, it's still going to have some time value. So to liquidate, I'd sell to close the put, so I get the intrinsic value from 32 to 40, $8, plus the $1 or $2 of time premium remaining. This option might be worth $10. So I sell to close this at 10, sell to close my stock at 32, I get $42 back instead of exercising my put at 40 and only getting 40 back as well. That is the guaranteed strike price. Okay, that's the guarantee of the put option. And of course, as we mentioned, when you buy the put option, yes, my cost basis is 43. That is my break even. If and only if I hold the position all the way to expiration, I choose to make no adjustments between now and July, and the stock is trading right at $43, we'd have no gain or loss. However, if the stock moves up to $42.50, let's say in the next 15 days from today, let's say February 15th, happy Valentine's Day, let's call it the 13th, right, day before Valentine's Day, look at that. If the stock moves up to $42.50, only about a $2 move in the next 15 days or so, we'd have a gain of $370 on the stock, but our put is not going to lose everything. it's only going to lose maybe $150, $160, $170. So if price of 420 down to maybe 360 or 350, or this one says 225, so it might drop as much as 2 points, but we're still at a profit of 175, right? Because the put's not decaying one-to-one with the stock. We're not down 7% from when we opened the position. Stephen, all we're losing when we first opened the position is the bid-ask spread of the put. You and I could have turned around and liquidated this position as soon as we opened it. We might have only gotten $4 for the put and maybe $3 and let's say $38.85 for the stock or so. So we still would have been close. We would have been at $42.85. So we would have only had a loss of 15 cents. Okay? All we're risking when we open the position is the bid-ask spread. But as time goes on, our put is losing time value. We want to use the income methods, and we want to see the gain in the stock to help counter the loss we're taking on the put. The reason why I haven't, if you're following Fusion, Stephen, this is the actual trade, as you know, that I'm in Fusion. The reason I haven't made an adjustment yet is because I haven't seen something that really matches what I want to do with this position with earnings coming up in 12 days. Okay, 12, 15 days. So it might be better off just leaving the position alone for now, waiting till after the earnings event. Now, if the stock moves up to $42 or $43, you know, in that example there, about $213 or $215 before expiration, I'll definitely do an adjustment in Fusion, in the Fusion portfolio for this position, and show that before the earnings come out to try to cut this risk by more than in half, maybe even potentially reduce all the risk, bulletproof the position prior to the earnings event, and we'll see what happens then. Okay? All right. Well, let's go back to our, sorry folks, let's go back here to the slide position there. Okay. Fantastic. All right. Fantastic. All right. So our upcoming webinar events. Tuesday at 12 noon Eastern Time, Kurt's going to have a discussion on radioactive trading. Wednesday at 12 noon. This might benefit Jerry. This might benefit some of the other questions that came in. This Wednesday, 12 noon Eastern Time, it's available in the webinar archives. We did a presentation on naked put positions. What is a naked put and naked put positions? A general introduction. Wednesday at 12 noon, it's already posted. You can register for that at the radioactive trading, You can register for Wednesday's Power Options webinar at PowerOptions.com or on the webinars page, the archive webinars page. We're going to talk about managing a naked put position. We had that discussion today, talking about the put that had fallen in price, averaging down, and so forth. We'll use illustrations of that discussion today on Wednesday's presentation, plus other ideas of managing a naked put. Let's see, Thursday at 12 noon, Kurt might not be doing income method number 12, but he mentioned he might be doing a Blueprint Owners webinar. And then, of course, next Friday at 4:30 p.m. Eastern Time, we'll be back for another open forum Q&A session as well. All right, well, ladies and gentlemen, if you think of any questions that you didn't get a chance to ask today, just send me an email at any time. You can send it to support@powerop.com. We're not going to be available for the rest of the afternoon, of course, by phone, but during market hours, you can give us a call at 877-992-7971 if you live inside the U.S., or you can reach us if you live outside the U.S. at 302-992-7971. Of course, there's contact links on the bottom of every Power Options page. Ladies and gentlemen, thank you again for joining me this afternoon. I hope you all enjoyed the presentation. And I hope to see you again next week for one of our other webinars coming up, our educational webinars coming up next week as well. Have a fantastic weekend, and we'll see you soon. Good night.